All right, today we are diving headfirst into this silver market. It has been on an absolutely explosive run, and we're going to break down the powerful and, frankly, conflicting forces that are pulling it in opposite directions. Let's get into it.
So the analysis we're looking at kicks off with this quote. And man, it just perfectly captures the moment. This is what happens when a trade works out almost too well, When the idea you scribbled down suddenly becomes a very real, very fast-moving thing. It's kind of a scary, but also an exciting place to be, where you have to recheck every single one of your assumptions.
And here's why things are so intense. 25%. Silver gained a staggering 25% in just 10 days. I mean, that's not just a rally. That's a parabolic surge that puts absolutely everyone on high alert. And that, right there, is the central tension of what we're talking about today.
So it all boils down to this one massive question that everyone is asking. Is this a spectacular blow-off top before a huge crash, something fueled by short-term hype, or are we actually witnessing the very, very beginning of a major structural repricing of silver itself? Let's explore both sides.
Okay, first things first, we have to respect the risks. There are some very real, very powerful arguments against silver right now. Serious headwinds that could absolutely stop this rally dead in its tracks. So let's break down the bear case.
The analysis lays out 4 immediate threats. First up, you've got potential tax-related selling in January as people lock in these huge gains. Second, a stronger US dollar is almost always a headwind for commodities. Third, you've got the technicals, which are basically screaming overbought, suggesting it's gone way too far, way too fast. And then there's the big one, the ghost of 2011 and the threat of margin hikes. If you talk to anyone who's been in this market for a while, 2011 is like a scar. The exchange, the CME, jacked up the margin, the collateral you need to trade, 5 times in just 8 days. It created a cascade of forced selling and just killed the rally. So the fear, of course, is that they're going to run the exact same playbook this time. But this is where it gets really interesting, because the situation today is completely different. Back in 2011, the market was running on insane leverage, like 25 to 1. Today, we're already at 6 to 1, which is actually tighter than where the 2011 rally ended. So that so-called margin kill switch, well, it's pretty much already been pulled. Any further hikes now would actually hurt the industrial producers trying to hedge more than the speculators.
So if that big, scary monster from 2011, the margin hike, doesn't seem like a real threat, what are the bears left with? Well, this quote from the source kind of says it all. You're going to hear the word overbought a million times. But the real story here isn't about some lines on a chart. It's about deep, structural shifts in supply and demand.
So let's flip the coin. Let's look at how this thing could be just getting started. Because when you peel back the layers of short-term noise, the deep structural forces are painting a very, very different and much more bullish picture for silver. Now, this is a huge and very time-sensitive catalyst. Starting January 1st, China's putting export licenses on silver. Why is that a big deal? Because they are a massive net exporter. We're talking about 121 million ounces a year. That flow of metal now needs government permission. They're treating silver like a strategic resource.
And check this out. This slide just lays the whole disconnect bare. While the paper price on the COMEX in New York is sitting at $77, physical buyers in Shanghai and Dubai are paying enormous premiums, up to $14 more for an ounce. When the physical price and the paper price get this far apart, that's a sign of serious stress in the market.
Okay, to really get what that stress means, we gotta quickly touch on this key concept, backwardation. It sounds a little wonky, but all it means is that the normal pricing curve flips upside down. And it is a massive red flag that there's a scramble for immediate physical supply.
This comparison makes it super clear. Look, in a normal market, you get paid to wait. The future price is higher. But in London today, the world's main hub for physical metal, the market is inverted. It is paying you a premium to deliver the metal right now. The physical market is literally screaming for supply. So where is all this new demand coming from? Well, a really powerful new driver is emerging. The AI revolution needs an almost unbelievable amount of electricity. To get that power, data centers are turning to solar. And guess what? You can't make today's high-efficiency solar panels without silver. So, the growth of AI is now directly fueling silver demand. It's a brand new equation.
All right, now for the biggest yeah but you always hear from the bears. Can't manufacturers just switch to cheaper copper if silver gets too pricey? Let's actually look at the math on this, not just the talking points.
This is the classic response, right? It sounds logical, it sounds simple, but when you really dig into the operational reality for an industry like solar, the story gets a whole lot more complicated. 4 years. Just let that number sink in. According to the analysis, it would take a minimum of 4 years just to convert half of the world's solar factories to use copper instead. It's not like flipping a switch. You have to retool entire factories. You can't just throw money at physics. This stuff takes time.
And here's the other key number you gotta know. $134 an ounce. That's the break-even price. That's the price where solar panel makers' profits go to zero. In other words, demand destruction doesn't even begin to be a serious conversation until we get to that level. We are a long, long way from there.
And here's the punchline, the great irony in all of this. While the bears are all talking about substituting away from silver, the solar industry is actually moving towards newer, more efficient panel technologies, which actually use more silver per watt, not less. So, how in the world do we make sense of all this? You've got these short-term bearish pressures clashing with this powerful, long-term structural bull case. It really all comes down to a battle between the paper price and physical reality, and knowing what signals to watch. So, the key takeaway here is this. Stop staring at the daily price wiggles. You need to watch the structure of the market. Keep an eye on that forward curve in London. Watch those physical premiums in Asia. These are the things that tell the true story of physical stress, long before it might show up in the daily price.
And that really summarizes the core conflict here, doesn't it? The risks from things like tax selling and a strong dollar are very real, but they're probably temporary. The bullish drivers, the physical shortages, the industrial demand, the new monetary interest, those are deep, structural, and very long-term.
And that leaves us with this final, powerful question. When the price of a paper derivative and the price of the actual physical thing it's supposed to represent tell two completely different stories, which one is wrong? History suggests it's usually the paper market that eventually has to wake up and adjust to reality. The only question is, when?